Welcome to GRE. I'm your host, Keith Weinhold. A penny saved is a penny earned. That's a quote attributed to Benjamin Franklin. In today's landscape, I wonder if he would have said, a penny borrowed is a penny leveraged. We're talking about today's mortgage lending landscape for investment property and what made interest rates suddenly drop a full 1% today on Get Rich Education. You can get a 50-year-old house somewhere or buy a new one directly from the builder with tenant-resilient amenities already built in. With over 3,000 Florida units at different construction stages, they are exclusively for investors. President Wagner and Alaska and team also invest strongly in their own product. That's belief. Start at buildtorentdirect.com. That's build the number 2 rentdirect.com or text 407-927-5074. Hey, is your IRA in a real estate syndication? Yikes, a 37% UBIT tax could hit you, but you still have a chance to set up your EQRP and avoid this. Did you make too much money in 2020 and need more deductions? Now federal law lets you set up an EQRP in 2021 and get deductions for last year, retroactively. Even put old IRA and 401k money in Bitcoin, gold, or your own business. Get control of all of your retirement money, tax and penalty free. Text EQRP in all capital letters to 72,000.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE, from Wilmington, North Carolina to Wilmington, Delaware, and across 188 nations worldwide. I'm Keith Weinhold. This is Get Rich Education. Sometimes interest rates are so low for so long, like they have been lately, that you can get lulled to sleep and get distracted by maybe other real estate news and finance items or just some other things that are going on in your life. And you kind of tell yourself, I'll get around to locking up those low rates sometime. And then earlier this year, something happened that made rates for investment properties and second homes jump up nearly overnight. Well, something just brought those rates back down again. We're going to talk about that. We have at least one show annually here that focuses on mortgage rates because as a homeowner or as an income property investor, it is your biggest payment anywhere in your life. Or for investments, it's your biggest ongoing expense with that property. Leverage has actually never been more advantageous since the inception of this very show 7 years ago, and that's for two reasons: low rates and torrid appreciation. With close to 20% year-over-year returns lately, well, if you have, say, 4-to-1 leverage, well, you just enjoyed an 80% return on your skin in the game, and instead, if you would have had a paid-off property, your return only would have been 20%. So now that income property loan mortgage rates have fallen by a full 1% here recently, it's perhaps a more germane time than ever for you to ask yourself, how do I optimize my loans? Well, I hope you've had a good investor week. I'll tell you, hopefully like you, I'm enjoying a time of high occupancy in my rentals, increased rents, and increased valuations too. So definitely mostly a good news story here with real estate lately. One downside trend that I guess I keep seeing are these increasing safety-related things that need to be done when you sell a property. Right now, I have an apartment building for sale so that I can trade it up for a larger apartment building. Well, before I can sell it, the buyer's inspection findings is that the window glass in the common areas, like the entryways and hallways, well, I need to add this safety film to the windows so that they're made somewhat shatter-proof or shatter-resistant to make them safer, sort of like an automobile's windshield glass is. Yeah, I'm gonna do it after some initial hesitation. I mean, safety is good, but to what extent? I'm spending a few $1,000s cash on this to get it ready for the buyer. I mean, how much safety is too much? You know, a few years ago, I bought a different apartment building, and the balustrade of the railing that goes all along the stairwell had to be enclosed with plexiglass. That's because before I could buy that building, my inspector said that the seller had to enclose these baluster openings. And the balusters are all those little vertical uprights that support the railing. Well, the inspector said that with the distance between the balusters being 8 inches or whatever it was, that was just too much. Maybe a pet or a child could possibly fall through there. Well, I guess that seems somewhat more likely to create a hazard than making residential windows shatterproof. But now that I've owned that building for a few years, the plexiglass that's all below the railing, between the railing and the floor, it gets these unsightly marks and these smudges on it, and then custodial has to clear that off every few weeks. It's just another thing to maintain. I mean, you can debate the merits of all this safety stuff, but some of this stuff has more merit than others. When they say you've got to have 4 carbon monoxide detectors and 18 smoke detectors, and they've all got to be connected to each other, plus make the windows shatter resistant, and plus close all the balustrade openings. I mean, although not right away, this cost eventually gets passed from landlords to tenants. And the other thing that does is it increases the minimum rent just to get into an entry-level place. And all of this has the effect then of increasing homelessness. That's my point. That's what all this does. But yeah, it's not common that 2 people are going to agree on what is a prudent safety level and what is excessive. Most people are going to draw that line in a different place. And as time goes on, I'm finding that a lot of these safety measures, guidelines, directives, they're more common in rental apartment buildings than they are in single-family homes, too. So this is a trend worth following. I mean, if selling a larger apartment building entails increasingly taller hurdles that a seller has to jump over, some sellers are just going to say, forget it. I'm not doing that. I'm not going to sell it then. That reduces liquidity in the marketplace if that happens. So my point is, safety is good, but too much safety is not. Well, before we talk about mortgage lending, as you're out there reading material and consuming media, you have probably noticed the same trend recently that I have. You're on a website, or you see an interesting story posted on social media, and you go to read it. And these news websites increasingly stymie you. They make it harder for you to read the article. You see more and more paywalls. News websites are increasingly riddled with for subscribers only sections, and then maybe some other sections that you can access, or you need to have a login before you can read that story. More banner ads, more pop-ups, more questions about will you or will you not accept cookies, and all these impediments just to read an article. Well, I write a newsletter sent directly from me to you, clearly without any of that stuff that I mentioned. And that's why this could be the golden age of quality email newsletters. Read mine. Give it a try. It's free. It's easy to access. There are no paywalls. There aren't pop-ups all over the place. And I do indeed write this myself. I do not have someone else write it and then proofread it. No, it all comes from me. So if you're looking for no fluff content that's of real value to you, free of spam, it's about real estate investing, the real estate economy, and with a little dose of mindset in there too, get my Don't Quit Your Daydream letter at getricheducation.com/letter. When you sign up, you do get a series of a few value-added welcome emails, and then after that, a Don't Quit Your Daydream letter is sent about weekly. It's not daily. It's not every other day. That is too much for most people. And you also get important breaking material sometimes, like this provider has available inventory right now, and even the property addresses sometimes. So you can cut through this increasing clutter of news websites and all the brain damage that these pop-ups induce. Get my free letter. Sign up right now for the greatest letter in all of American real estate investing. At least I think so. At getricheducation.com/letter. And there won't be any commentary about balusters or banisters in there either. Again, that is at getricheducation.com/letter. Let's discuss today's mortgage lending landscape. I'd like to welcome in the president of Ridge Lending Group. They provide income property loans for 1 to 4 unit properties in almost every U.S. state now. They just keep growing, and they've already helped more families realize their dreams of homeownership as real estate investors than any other mortgage lender in the entire nation. They have so many repeat customers and referrals, and it's where I got my last few loans and where I did my last few refinancings. She is a 20-plus year real estate investor herself. Welcome back to Get Rich Education, Caeli Ridge.
Keith, thank you so much for having me. You know how much I love being here with you and your listeners. It's a privilege, my friend.
It's soothing at this point. You're such a familiar voice. You're kind of the voice of the loans that so many of our listeners have by now, Caeli. So it's really an interesting time here. You know, I think one can make the case that debt-free makes less sense than it ever has. Potentially, mortgage interest rates and all other interest rates really began getting unusually low, call it a decade or so. And now we've reached a point where the rate of inflation is even lower than what mortgage and a lot of other interest rates are. So in effect, if you don't borrow, your prosperity diminishes.
I think that's a good point. And I think that you're right. We find ourselves in a unique environment where we can take distinct advantage of these low interest rates and harvesting the equity that we built in our homes, whether primary residence or investment property. 30-year fixed mortgages in the 2s and 3%, you'll never find cheaper money than that. Borrowed funds are non-taxable. So 1,000%, this is a unique opportunity for Americans.
3 years ago, some people said, oh, no, rates would never get this low as they are today, oftentimes in the 2s for primary residences and in the 3s for income properties. You say the word Americans, and these terms really are especially advantageous for Americans. When you look globally, a lot of people don't understand that people don't have this advantage of a 30-year fixed rate with the 30-year amortization. For example, Canadians, they can get longer amortizations, but they typically need to refinance to market rates every 5 years. So they're at the whims of the market, where in the United States, you can sort of buy the dip, the mortgage interest rate dip, and hold it for 30 years.
Absolutely. And it's funny, a lot of people aren't aware of this, that we are one of the only countries on the planet, literally, that are providing a 30-year amortized loan that is fixed for 30 years. That's a very, very unique thing to the U.S. I haven't double-checked this statistic in a while, but 5-7 years ago, we were one of 3 countries, literally, that provided that 30-year fixed mortgage on a 30-year AM. It's rare.
That is a rare thing. And then even with those other countries, I don't know if they have the same property ownership rights and some of the other things that Americans are privileged to as well. So we've really got a good thing for us here in the United States, but some people aren't taking complete advantage of it. That really leads to the next thing. We talk about taking complete advantage of it in getting as many income property loans as we can responsibly. There was a substantial change in the lending landscape that occurred earlier this year. But the great news for real estate investors is that was reversed just a few weeks ago. Tell us about that, Caeli.
Yeah, I'm so excited you brought that up. You know how I go with my rabbit holes sometimes, Keith, so I'll try and keep it succinct. March 10th, to be specific, we were informed, there was an announcement from the FHFA that told us that the Treasury, who has been buying mortgage-backed securities to the tune of $40 billion a week, that the Treasury's senior preferred purchase agreement was adding layers of risk to second home and non-owner occupied occupancies so that they limited the amount of purchasing per aggregator to 7%. Let me define what that means. So if I'm selling $10 million worth of mortgage-backed securities to this aggregator, and we have dozens of them, but this particular aggregator, no more than 7% of that bundle of mortgage-backed securities or loans can be for second home or non-owner occupied. So that announcement, the trickle-down effect of that, I mean, it didn't cause us any heartburn in terms of our funding ability, but what it did do is the secondary markets got wind of this, and they increased what are called loan level price adjustments. An easier way to say that, interest rates for both of those second home and investment properties went up overnight by about a full percentage point.
Gosh.
Result of that announcement.
Yeah.
Fast forward, a couple of weeks ago, we got a new announcement that the FHFA is suspending that ruling. So within 24 hours, no kidding, within 24 hours, we saw the repricing of rates for investment properties. And we're back in the threes, man. I mean, I'm giddy.
Back in the threes for non-owner occupied properties. That is some really good news. Okay, so the effect that a prospective borrower feels was all in that interest rate, really. Well, let's talk about that. Before we get into some more advanced things, Caeli, why don't we drop back now that we have rates that are advantageous again for income property investors? Talk about that baseline criterion of what it takes to get to an income property.
So if we're going to focus just in this part of our conversation on a conventional basis, the Fannie Mae, Freddie Mac loans, there's three primary characteristics that we really focus most of our attention on to qualify an individual borrower: credit, assets, and debt to income ratio. Credit, I'm just going to give you the quick back of the napkin baseline. 680 or better is typically what we want to see. The higher the credit, the better the interest rate. Assets, we're going to need to show liquid assets for your down payment if it's a purchase, and sourced and seasoned funds is required. I can define that in a second. And then there's a reserve matrix that also goes along with assets. I'll come back and define both of those in more detail. And then the debt to income ratio is a simple 50%. It's probably too much to try and quantify how that works, because there's going to be distinct differences between if you're a wage earner, W-2, or if you're self-employed with lots of K-1s. But 50% is the max DTI threshold. I'll quickly go back to the assets. Sourced and seasoned funds means that 60 days worth of bank statements that you're using to show where your money is coming from to purchase this property, those funds must be shown as having originated with the individual. So if there's a large deposit listed in the statements that we have received, we will question it. And as long as I can show that it started with Mr. Smith, those are sourced and seasoned funds. The reserve matrix is a little bit more complicated.
And on previous episodes, Caeli and I also gave a number of examples on the debt to income ratio calculations, that threshold that you don't want to exceed, that proportion of all of your monthly debts to all your monthly income, not exceeding 50%. For a long time, a lot of people think it takes a 20% down payment for income property, but you've been quick to remind us that's not quite true. You can put down as little as 15%, but lending is a quickly changing landscape. Is that still where we're at, 15 to 20% down payment for an income property, a non-owner occupied single family home?
You're right. It's a moving target, and so it is subject to change at a whim. But yes, conventionally, Fannie, Freddie, I'll keep repeating that, 15% down is allowed on a single family residence. The interest rate will be slightly higher, and there is PMI, private mortgage insurance, associated with any conventional loan that's over 80%. I may say that depending on the individual circumstances, looking at a 15% down versus a 20% down side by side and figuring out the capital expenditure, the 5% between those two, and what the monthly payment difference is, even with the higher rate and the PMI on the 85%, it's not as big a number as one might suggest or think. And if it can retain 5% that they can then use for another down payment on other property, the higher leverage, generally speaking, tends to win in the ROI conversation.
If one does choose to go the 15% down route, how quickly can they get rid of the PMI?
Ooh, good question. Fannie Mae and Freddie Mac have different sets of circumstances or rules for that. I should know this, but I'm going to have to go back and look. One is 12 months minimum, the other is 24 months. So depending on which is which, you're going to have to keep it a minimum of 1 year to 2 years, whereby some combination of appreciation or principal balance reduction, if they're making extra principal balance payments, etc., as long as the loan to value hits 78%. That sounds odd, 80% is supposed to be that threshold, but you have to hit 78% LTV by appreciation or principal balance paydown to remove the PMI with the cost of a new appraisal.
Okay, so that might take another appraisal. So if one puts 15% down, they would be expected to pay a higher interest rate by a little bit. Of course, it would be a higher payment just because they're borrowing 85% rather than borrowing 80% if they put 20% down. And then finally, if someone puts 15% down, they would indeed have to pay that PMI premium for at least a year or two. So those are some of the things to consider. Of course, you're getting about 7-to-1 leverage with 15% down, 5-to-1 leverage with 20% down. It's about running numbers and seeing what works for you as an investor there. And then because you do income property loans in most every state, when someone wonders, now how much does it cost me to get into a property? We typically still looking at an average of about 4% closing costs.
Yeah, I think that's fair. It will vary. I think that's probably a good national average. Yeah. Different states are going to impose different costs, like transfer taxes, property taxes might be higher here than there. But yeah, overall, I think that's a decent national average.
For a new investor, that's adding 4% on to your 15 to 20% down payment as to what percent of the property value that you need to come to the closing table with. Caeli, before I go on, are there just some more basics of loan qualification that someone ought to know?
The things that we always try to announce in advance and set the appropriate expectation when they're trying to qualify for financing, mortgage financing, and they're getting through the loan, it's important not to establish or secure any new debt, especially without telling your lender in advance of your plans, just to make sure that the addition of that new monthly debt doesn't derail the loan transaction. The other big thing that we try to communicate is traveling during a loan transaction. It can be prohibitive if we're trying to schedule for signing loan documents and notaries and things like that. Those might be two little things that I would put out there.
Another question that especially I think a lot of beginners have, maybe if they're just trying to get the funds to get into something, the question is, now, should I buy with a business partner? What if we go ahead and split this duplex or fourplex or single family home 50-50? Do you have any thoughts that way when it comes to qualifying for loans with a business partner?
It will be circumstantial to the partner's individual qualifications and criteria and goals. But more often than not, what we will advise is you really want to try and maximize those golden tickets. So if you and your business partner have whatever the ambitions are for acquiring residential property, and without having all of the pieces to the puzzle, I think the first thing I would say is try to qualify each other individually, right? Maximize the access to the Fannie Freddie loans. So instead of doing 10 together, which is the threshold, 10 max per qualified individual, now potentially you have 20 together. So that would be my comment there.
You have 20 together. I mean, currently, and when you talk about the golden tickets, we're talking about how an individual borrower can get up to 10 loans at the best rates in terms of married couple 20. Are you saying that if you go together with a partner on one, I mean, just say a buddy of yours that you're not related to, and you both go halves, that would take up one loan position for both you and your buddy?
Yes, absolutely. So the definition that Fannie Freddie give us for what counts against the 10 is any residential property, single family to 4-unit, condo, etc., that has a loan, a lien attached to the property that was either in your individual name or personally guaranteed by you. That counts as well. Similar to a husband and wife team, business partners can look at it from the same perspective. What two people agree to on the outside of the loan transaction is entirely legal. So Joe and John, Joe buys 10 and John buys 10, and they have agreements between the two of them that discuss what kind of cash flow split they're going to receive, what kind of equity and appreciation each one can account for, what kind of tax deduction this one's going to take versus that one. That's perfectly fine. That's how I would do it.
Okay, but you're just burning up one of your golden ticket spots and only getting half of the benefit.
If you were to do it jointly, yes. That's why I would say separate the two.
That makes quite a bit of sense. Well, we talked about interest rates earlier. They are so favorable. I want to ask you, what are interest rates today? I know that has an answer of it depends. If someone just has what I would call average credit and a DTI that qualifies for, say, a non-owner occupied single family home, what kind of rate are we looking at today?
Okay, I'm going to add in at 20% down on a 30-year fixed at a loan amount of, say, $150,000, they're probably at about 3.75 today.
Gosh, yeah, that is historically astounding. We talk about interest rates and that 3.75%. We're probably talking about a safe borrower there. Why don't we look at this from the perspective of lenders and how lenders view borrowers and borrower risk premiums? So, for example, with that 3.75% example that we just talked about with a certain borrower, a lender might be better making that loan and only collecting 3.75% from that presumed safe borrower than they would getting 5.75% over here from this other reckless borrower that has a really rough track record and not very many assets and so on. Can you talk to us about some of those risk premiums that banks add and say, I deem this borrower to be of a greater risk, so therefore I want to add 0.5% onto their interest rate, or make them put 30% down rather than 20% down? So from the lender's perspective, can you talk to us some more about risk premiums and how they perceive borrowers?
To maybe quantify a little bit more, the low rates that we're talking about over here for the lower risk borrowers, the interest rates are that low because they come with the United States guarantee. The Fannie Mae, Freddie Mac loans in conservatorship right now, that means basically that they're backed by the US government. And that's why those rates are so low. In the event of default, if I were to default on a loan and the investor that purchased my mortgage-backed security was now at risk, the US, Fannie, Freddie are going to come in and buy that paper back from me. So that's really why, I mean, that's a pretty, you think about the United States, you get a guarantee from the USA, that's why those rates are so low. So when we talk about outside of that box, non-QM or what have you, the borrowers that are going to be qualifying for the higher interest rates, either, maybe their credit is a risk layering, their credit isn't as good, they've got some bankruptcies or collections or judgments that are a year or two old, they can still get financing, but they're going to pay for it. Maybe they can't show tax returns as a means of income because they take too many deductions, or maybe they don't have 2 full years of self-employed. I mean, there could be so many variables that come into play here, but those individuals still are financeable. But yeah, for those reasons, they're going to be taking a higher interest rate. They're going to pay a premium to get financing.
Caeli brings up an interesting point that we haven't talked about on this show before. When you consider that there are federal backstops on this 3.75 incredibly historically low rate that we're talking about, effectively, you, the listener, your taxpayer dollars are subsidizing that backstop to create that safety net for that lender. So therefore, it behooves you to take total advantage of these loans because in a sense, you are subsidizing them. You're paying them.
Absolutely.
So be profitable on the other end. Well, Caeli and I have a lot more to discuss about the lending landscape today. You can learn more about them in the meantime at ridgelendinggroup.com. More with Caeli and I when we come back. I'm your host, Keith Weinhold. The people that our listeners can't stop talking about are Ridge Lending Group, NMLS 42056. They've provided GRE listeners with more loans than anyone, and it's where I got my last few loans. They finance single-family income property up to 4plexes. They're the #1 lender for beginners and veterans. Start your pre-qualification, chat with President Caeli Ridge personally, and get your custom plan for expanding your cash-flowing portfolio. Start at ridgelendinggroup.com. A lot of investors choose either cash flow or home price appreciation, but one real estate market could provide both: Jacksonville, Florida. They've got 27% lower home prices and higher rents than the national median. Their market has appreciated 34% more than other comparable cash flow markets over the last 30 years. Get positive cash flow today and above average appreciation for tomorrow. They often have available inventory in Jacksonville, if you can believe that. Start at cashflowandgrowth.com.
This is Rich Dad Advisor Ken McElroy. Listen to Get Rich Education with Keith Weinhold and don't quit your daydream.
Welcome back to Get Rich Education. We're talking with Caeli Ridge. She's a familiar guest. She's the president of Ridge Lending Group. Learn more about them and get started on your income property loan at ridgelendinggroup.com. They also do primary residence loans, something that we don't talk about a whole lot, so you can look them up for that as well. Caeli, I talk to a lot of people, and there seems to be this misconception in the marketplace, or maybe it's the truth. I'm going to ask you so you can sort it out. A lot of people say that, well, you can't get more than 10 loans for 1 to 4 unit properties if you're single, or 20 if you're married, because the terms just get so awful and so sour after that it just sours nearly every deal. So we call those first 10 or 20 those golden ticket loan spots, those ones at the best rates and terms. Tell us how different the terms are when you go beyond 10, like if a single person wanted to get 15 loans for 1 to 4 unit income properties, for example.
There's going to be a variety of options available to the individual, but assuming that we want to stay in that 30-year fixed bucket, right? Similar leverage, 30-year fixed amortization, 30-year fixed rate. The options are actually a lot more similar to the Fannie Freddie than I think people realize. A couple quick things. This is called non-QM. These particular loans are called non-QM. That stands for non, obviously. QM is qualified mortgage. Dodd-Frank, most people have heard that term before, rewrote this country's financial landscape back after the 08-09 crash. And within some of those provisions came qualified mortgage. Fannie Mae, Freddie Mac are defined as qualified mortgages. So now, just by default, everything outside of that is non-QM. Non-QM is an extremely diverse product line that is not just for investors. It's for anybody really that just doesn't fit inside the conventional Fannie, Freddie, or FHA or VA box. How it does apply to us as investors, once you've maxed out your 10, one of the great things about non-QM is the restriction of that max 10 doesn't exist anymore. You can get as many loans in the non-QM as you want.
40 of them, 80 of them.
If you qualify based on that, the criteria, absolutely. So 30-year fixed, similar leverage. Underwriting guidelines are actually pretty similar in the debt to income ratio and the credit score. They're a little looser, right? They're not going to be as stringent as the Fannie Freddie. But for this particular borrower, they've just maxed out their 10 and they want to keep going with those similar terms. And we're finding as time goes on, the interest rate margin between the Fannie Freddies and these non-QMs are starting to narrow a little bit. Interest rates change daily on the conventional side, right? Sometimes they can move multiple times a day. That's not necessarily true on non-QM. So from a few weeks ago and the announcement that really brought non-owner occupied rates down for conventional, we haven't necessarily seen that translate or trickle down to the non-QM yet. However, I expect to see it in the coming days and weeks. Generally speaking, you're going to be about a point different in rate between a Fannie Freddie and a non-QM. And to put that in perspective, it's largely going to depend on the loan size, how big or how small that particular spread is. We've talked about this many times, Keith, and that on $150,000, a 1 percentage point difference between 375 and 475, let's say, the principal and interest might be $60 a month, $50 a month. Just to kind of put it out there, I think people are surprised to learn that a whole percentage point on a smaller loan amount isn't as big a difference.
And there's no balloon payment due on these non-QMs or anything else like that that's substantially different from those golden tickets other than what you mentioned?
The only thing that's going to be different is that they will have prepayment penalties, but these are straight 30-year fixed mortgages. No ARM, no balloon, no, not on that particular product. The prepayment penalty typically is going to be 3 years. And just quickly, how you're going to calculate that, you're going to take 6 months of interest on 80% of the outstanding principal balance. And that's how you'll figure out if you tried to get out of the loan in the first 36 months by sale or refinance, there will be a penalty to do so.
Yeah, there aren't very many circumstances where one would buy a property where they would want to get out of it within 3 years anyway. So that's really good for these non-QM loans, this product that you offer beyond the golden tickets. That's really encouraging to hear about. Is there something to be said when it comes to someone optimizing their loan spots in not using loans for properties that are too small? Say, for example, a $75,000 property in a market like Memphis, where there are often lower purchase prices, and that would therefore create a $60,000 loan. Is there something to be said for maybe even paying all cash for a property sometimes in a situation like that and saving your golden ticket loan spots for more like a $200,000 loan?
I think so. I mean, if you think of the cost of money and finance and the leverage that you can get, especially with the rates this low, generally speaking, our advice is going to be to save your golden tickets for the higher price point properties. If you need leverage for the smaller, I think that looking at some sort of a cross-collateralization commercial loan is probably a decent bet, maybe non-recourse. What that means is that you can take residential properties and put them into one blanket commercial loan. So when you hear the term cross-collateralization, all of these properties are attached together in this one blanket commercial loan. That might be a good way. There's going to be some minimums in there that might be more restrictive with the smaller property sizes. Our minimum for commercial is $500,000, so you'd have to have quite a few of those. But yeah, I think generally speaking, I agree. I would save my golden tickets for the higher price point.
Do you offer those cross-collateralized loans like you just mentioned there as well?
We absolutely do.
Oh, that's great. Generally, I am certainly a leverage fan, as all of our listeners know. But yeah, you might have to change things up when you're looking at some of those really low purchase price properties and preserving your borrowing power with those golden ticket loans. Caeli, we've seen such a fantastic price run up of really all real estate types in America for the last 12 to 15 months, something like that. And this has created equity that's really just poured out into the streets all over the place. And we're conscious here at GRE that the rate of return from home equity is actually zero. So we want to deploy that sleepy money into more property, or maybe just do a cash out refi and use some of the money for lifestyle. It's not earning any return in property. So with that in mind and all this equity that's been built up, why don't we talk about some of those cash out refinance, the loan to values and the terms, and whether they're different for rental single family homes versus duplexes, triplexes, fourplexes. Talk about the refinance landscape.
Like I said earlier, too, borrowed funds are non-taxable. So anything that you're going to take out of your harvested equity is not going to be taxable income. It's a pretty common strategy for investors to utilize that appreciation and grab the money and go buy their next piece of property. So here's what you need to know, again, staying on the conventional side, about the maximums in the leveraging, and I'll throw out some rates too. So single family residence, well, actually, let me back up. There's going to be a rate and term refinance, which I think we're going to focus on cash out. But just so that people are aware, rate and term refinance means that you're just going to replace your existing mortgage with a new mortgage. You're not actually going to be getting cash back. On a single family residence, you can take that to 80% loan to value. And on a 2 to 4, you can take that to 75% loan to value. That's the rate and term. Focusing on the cash out, which I think is the purpose of this part of our commentary, single family residence, 75% loan to value, and 2 to 4 unit residence is going to be 70% loan to value on a cash out refinance. Interest rates right now still are going to be in the threes. From rate and term to cash out and the property types and everything in between, you're probably right now going to be between 3.25 and 3.875, depending on those variables.
Yeah, that's really some excellent news. Indeed, a tax-free event, because the IRS classifies this as debt that you're taking on. Therefore, it's a non-taxable event. And yes, we talked about risk premiums earlier. You have these lenders, when they see you take cash out, they want you to leave a little more equity in the property. Is that because they deem that as more of a risk a bit if you're taking cash out? So therefore, they want to give you a lower LTV by 5% when you do the cash out versus when you do the rate and term?
Absolutely, right? You're borrowing cash, you're getting cash, and not knowing what that cash is going to be used for. It just comes with an extra layer of risk, and that's why the rate will be higher and the LTV will be lower.
Yeah, that makes a lot of sense. Well, you specialized in income property loans there for such a long time. Like I said earlier, you've done more loans for our listeners than any other lender in the nation. And you really do have a number of distinct advantages there. And you also do primary residence loans, like you mentioned earlier. Tell us about some of those advantages that people find, why that keeps them coming back to Ridge, because you have so many good reviews and so much repeat business and so many referrals. So tell us more about why Ridge is different than your big box lender.
Thanks, Keith. That pleases me that you mentioned that. And without sounding too arrogant or too braggadocious about Ridge, I agree. I have to agree. We're very well suited for the investor. We're good at what we do. I think overall what I would say is that we've got the education piece, which is a huge value add. Most of what we're able to teach our clients cannot be found on a Dr. Google search, right? This is just not stuff that's out there and available. And having that information that is current and accurate as it applies to them specifically, teaching them how to optimize those qualifications based on their futuristic goals, I think is a pretty big deal. In addition, we are so investor friendly, we are not going to impose industry-wide overlays, which means big boy bank might say, okay, Fannie Freddie says you can get up to 10 finance properties, but we're going to cut you at 4. That's an overlay. We're not going to impose any overlays. We go straight by the Fannie Freddie rules. We're not a one-size-fits-all. We have a whole variety of loan options, as we mentioned earlier, the conventional, the non-QM, the commercial. We have even bridge money for short-term fix and flippers. Our extensive background and knowledge and spending so much time focused on investor needs, I think comes through in our work. Then you've got the customer service and the very marketable rates and terms. We're very competitive, very responsive. I think you'd be hard pressed to find another lender that has the big picture, the whole acumen that we have.
You specialize in it. It is exactly what you do. Well, if you want to learn more and get started with your loan, maybe you thought it wasn't possible previously or you didn't know what it took, let our audience know how they can do that, Caeli.
I would love to hear from them. They can find us a couple different ways on our website, ridgelendinggroup.com. They can email us, info@ridgelendinggroup.com, and they are welcome to call us anytime at 855-74-RIDGE, 855-747-4343.
Caeli Ridge, it's been valuable as always. Thanks so much for coming back onto the show.
Thanks, Keith.
Oh yeah, nice job with making things clear from Caeli again. Just like the number of days in a year, you are listening to episode 365 of Get Rich Education. You know, in life or investing, you want to play a game worth winning. Real estate is that long game, and optimizing your mortgages and your leverage is as well. And with the resurgent equity run-up and the low rates, there has never in the history of this show been a better time to do something like a cash-out refinance of your primary residence and then positioning it into more income property if you have indeed decided that that's the right move for you. Yes, when we talk about harvesting equity and then giving you the ability to redeploy it, it is fall. It is autumn, October. It's time to initiate getting everything harvested before winter sets in. If you think that the winter is going to involve a Fed taper announcement next month, because that is something that correlates with an interest rate rise. Now, that's the upside. That is great. Understand that if you're new, no matter where you add leverage with mortgage loans, you're going to want to keep in mind that you don't just click one button on a screen and get this loan done. So just tell yourself up front that it's going to take, let's say, an entire day of you submitting documentation and so on. And that day's worth of work might be spread out over several weeks. And your inbox will have a number of emails in it. Your underwriter needs certain documentation. But it typically is that game worth winning. Big thanks to Caeli Ridge today. You can do what countless numbers of our listeners and me myself have done several times, if you wish, by giving them a call or starting at ridgelendinggroup.com. Until next week, I'm your host, Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
The preceding program was brought to you by your home for wealth building, GetRichEducation.com.